Hi, Don Melchek here, and with domestic reporting season kicking off at the start of February, I thought I'd provide a bit of an overview of our expectations for earnings across different market sectors, as well as what we'll be watching out for on key positions in our Infinity Core Australian equity portfolio, as we look to continue to build on the consistent outperformance that we've delivered over the past 1, 3 and 5 years. Broadly speaking, I don't think it's any surprise that key focus during this reporting season will be the impact of inflation and supply chain disruptions. And while there's no doubt that Omicron has thrown up challenges for company management teams dealing with labour shortages and product availability, ultimately we see these as being short-term in nature, and we're willing to look through some of this as we believe that the underlying demand drivers remain positive and corporate balance sheets remain in good shape, which should both bode well for the interim results out in February, as well as FY22 releases later this year, where we expect earnings growth to remain positive and in the mid to high single-digit range. This has been echoed in current market expectations, where earnings have been upgraded quite significantly to kickstart the year in January. We've already had a host of production updates across the resources sector, and we're therefore not expecting any major surprises from key positions in our portfolio like BHP, Oz Minerals, Alumina or Woodside. Although the spot price of iron ore is substantially below the levels we saw this time last year, and we don't expect them to get back to those highs, we think that the increased Chinese infrastructure investment following the recent policy unwind could extend the above average pricing, which would play out well for BHP as second quarter shipment levels remain strong. Base metal prices have also enjoyed a strong performance period, which should drive BHP's copper earnings, although management have now pointed towards lower end of the guidance range in production levels. Oz Minerals earnings will also benefit from higher copper prices. However, plant maintenance, resourcing constraints and higher freight rates have put some upward pressure on costs, which may offset some of these gains in the near term. Energy companies like Woodside should deliver strong earnings this reporting season on the elevated pricing, and we wouldn't be surprised to see further upgrades to consensus expectations. In the consumer space, recent trading updates from the likes of Wesfarmers and Woolworths have reflected current trends in retail that we expect to continue into the reporting season, with the standard supply chain constraints already mentioned, coupled with a slowdown in foot traffic and lower margins as a shoppers shift to online ordering. Although we believe that current share price levels reflect these impacts. In Wesfarmers' case, housing-related categories remain strong, which should help drive earnings for Bunnings, a theme which has also been very positive for James Hardie, who has already delivered a solid third quarter result, with upgrades to profit guidance for the full year on the back of a strong US housing market and new product launches, which we think still provide some scope for further upgrades and beats. We think the healthcare, IT and broader industrial sectors may provide a bit more of a mixed bag of results this reporting season, with the likes of Goodman Group and Altium enjoying strong demand momentum and in the category of most likely to beat market expectations in our view. While we'll also be keeping a close eye on CSL's blood plasma collections in the hope that they'll return towards pre-pandemic levels. Ditto for Transurban and their traffic volumes, while Lendlease needs to build on the recent transparency from the last year's strategy day and show some progress on recalibrating their cost base, together with working towards their FY23 and 24 targets, which will see significant increases to the development and production pipeline. Just lastly on capital management, last reporting season we saw a huge 18-odd billion of buybacks, capital returns and special dividends announced. We don't expect the same level of returns this time around. However, we do still expect strong capital returns in the way of normal dividends, and we're looking for the overall dividend yield of the market to continue to steadily move higher towards the longer-term average of 4.5%. So with that, thanks for listening, and as always, if you have any questions, feel free to reach out to anyone in the team, and I look forward to providing further market and portfolio updates throughout the year.